Welcome, Nishant, to Chat with Traders community. So my understanding is by trade, you are still are a software engineer?
Yeah, so I went to college to train to become a software engineer. I was in that career for 20 years. I'm not actively in the software engineering field. I'm a full-time trader. That's what I do right now. I'm also the author of a book called Mean Reversion Trading Using Options, which has been a bestseller on Amazon for the last 4 years.
But maybe for the listeners, if you could share what were some of your early option strategies. Most people think of options, say, well, stock's going to go up, I'll just buy a call option and I can get a leveraged play on its upside potential, and vice versa with a put. Did you just getting into buying calls and puts initially, or did you get into any other strategies?
Yeah, so if you talk to any option traders, all of them have the same journey. So I had this similar journey too. So initially, all I knew was calls and puts. And then, like I was telling you, I didn't have that much money set aside to, for example, if you buy a call option, a deep in the money call option on Google, it will cost you like thousands of dollars, $10,000, $12,000 per call. So I couldn't buy, and if you pick up any book on basic book on options, they will tell you buy deep in the money options, right? So,
and why is that? I mean, what's the problem? I see a lot of volume on the exchanges. So many people buy these much cheaper options. The cheaper options seem more economical, aren't they?
There's something called a delta associated with an option. So when the stock price goes up by $1, you have to look at the delta on your option. Your option will appreciate in value by that delta. So, for example, let's say a stock is trading at $100 per share, and you buy an at the money call option, which is a 100 strike call option. At the money option will have a delta of 50. So what that means is every time the stock goes up $1, you would only go up 50 cents, or option multiplier $100 is $50. So if you buy deep in the money option, so let's say the stock is trading at $100 per share. If you buy 90 delta option, which is what most books will recommend you, buy 90 or more delta, you are pretty close to getting the same appreciation in your option as the stock as it's going up, because stock goes up $1, you make 90 cents. So as you go up, increase the delta, you make more money. The problem with higher delta is that it costs a lot. So a normal retail trader cannot afford to buy even a 90 delta option on a high price stock. So what many traders do is, and I made the same mistake too, they will look for the cheapest option in the option chain, and they will start buying like a out of the money 10 delta option, because it feels cheap to you. Instead of spending $12,000 on buying a 90 delta call option, let me just spend $1,000 and buy a 10 delta call option. The problem with that is when the stock goes up $1, you only make 10 cents. And what people don't realize is that unlike shares, options are multi-dimensional beings. So their price is affected by a lot of things. One thing which people, at least new traders, ignore completely is theta or time decay. Every day you are holding that call option in your account and the stock doesn't go up, you are losing money. You're literally bleeding money on a daily basis due to time decay. So all these options are basically, when you buy an option, it's a wasting asset. So if the stock doesn't go in your direction almost immediately, you will keep bleeding money until the time the option value goes to zero. So, yeah, I started out with buying out of the money option, like everybody else, right? So I think of out of the money options like lottery tickets. So you almost never make money, but you have the potential of making infinite returns. That's what attracts newbie option traders to just buying calls and puts. And eventually what I did was I kept reading books, kept trying different strategies. So like you name any option strategy, I must have tried it, like, iron condors, iron butterflies, straddles, triangles, you name it. I've tried everything. And what I realized was that there is no need, the way our human brains work is, I don't know how it is, that we love to find complicated solutions to simple problems. And what I realized is by unnecessarily complicating my trading, I'm not gaining anything. So I started on this journey of simplifying my trading as much as possible. And I've detailed my entire strategy in my book, which I mentioned earlier. So I ended up by just trading vertical spreads and specifically debit spreads.
You went on a quest to learn all the different types of option strategies, including ones that are not reliant upon the stock making a massive move in one direction or the other, like you would be if you bought a straight call that most people would imagine, right?
I don't know any trader out there who has made it by just buying calls and puts. So the thing with calls is what attracts new traders is that the potential of infinite returns. I compare it to a lottery ticket because lottery ticket also comes with the potential of infinite returns, but you are 1,000 times more likely to get hit by lightning than winning the lottery. So with option is the same thing. So when something comes with infinite returns, the probability of that happening is really low. Initially, in my initial years, I used to buy call options. So one problem I encountered with that is even if the stock goes in your direction, what you will find yourself is you don't know when to pull the plug on that trade because, again, that's the problem with the potential of infinite returns, that stock starts going up. You're making money. You're happy. The problem is, at what point do you close that trade? So what people find themselves in a situation is that they don't know when to register profits or book profits. And I struggle with the same thing too. And that's what led me to defined risk and defined return trades, which is what a spread is. So with a spread, the quickest example would be, let's say a stock is trading at $100 per share. And if you want to buy a $5 wide call debit spread, what you would do is you would buy a $100 call and sell a $105 call at the same time. That is your spread. And it's a defined risk trade because the money that you spend buying that debit spread is the money you can lose. You can't lose any more than that. But it also comes with, if you want to call it a negative, is you can't make more money than the width of the spread. So in this example I gave you, the maximum value of that spread can be $5, which is $500. The stock can go to infinity and you will still make $500 on that trade. So you are capping your profits at a point, and some people will like, why cap your profits? If the stock keeps going up, why not just make infinite amount of money? So the nice thing about capping profits is that you know when to close that trade. There is no guesswork involved. So if this is 100, this price is 100, and this is 105. So that's your spread. You bought a 100 call and you sold a 105 call. Stock is shooting up to 105. The moment it goes above 105, that is when you hit your profit limit. So the nice thing about that, what I find is with these debit spreads, you double your money if a stock moves just $5. And then you don't have to guess when to close it because from stock can go from 105 to 505. You still make the same money. Can go to 106. You still double your money. So then you will just simply close it at 106 then. So that's the nice thing about defined risk trade. It takes out the guesswork of figuring out when to close a trade to book your profits.
We have a question from Tessa.
Yes, Nishant, earlier you mentioned about, two Greeks, the delta and the theta. How much do you pay attention to the Greeks in your strategy? Because I know that some of the Greeks are something that some people are intimidated by because you don't know how to use it. And I'm just curious to see how important is it to you in your strategy?
Options are multidimensional beings. And the price is affected by not just the price of the underlying, it's the time decay, it's the implied volatility, it's the gamma. So there are many things that affect it. And like I was mentioning earlier, that I was on this quest to simplify my trading strategy, because trading itself is on its own is a very difficult thing to learning to how to trade. And then you add complications like all these Greeks and how they will affect your price. So what I did was, so when you do spread, like I mentioned, right? So if you buy a call option, it's exposed to all these Greeks that you mentioned, time decay, gamma, delta, all this stuff, IV. When you buy a spread, so the Greeks of the call that you buy are pretty much canceled out by the call that you sell. And that's what brings so much simplification to this style of trading, that you don't have to worry about anything. You don't worry about IV, you don't worry about time decay. Only thing you worry about is price.
Nishant, can you show us some charts that maybe you can share with us, your methodology on how and when you would pick to enter into your spreads?
So let me start here. So this is a chart of the Atlassian team with the sticker. So this chart, I just deliberately chose a blank chart. There are no indicators, nothing on this. It's just candlesticks. And this is a 6-month daily chart. And every single candle represents the price action for a day. So this is one day, this is one day, this is one day. The green ones are like in the stock opened here, closed here. The red ones are stock opened here, closed here. So down day and up day. Now, by just looking at this, I don't think anybody can make any trading decisions. At least I can. Let me add some indicators here. So on this screen, what I've done is I have added a technical indicator called Bollinger Bands and Keltner Channels. So these lines, the green line, which is going up and down wildly, and the red line, these are the Bollinger Bands. And what Bollinger Bands are, they are a big part of my strategy. These lines are plotted at 2 standard deviation. And if you remember your statistics lessons from school, a 2 standard deviation move captures 95% of the price movement, right? So all the data points, 95% of the data points are captured in a 2 standard deviation move. So what the nice thing about Bollinger Bands is that it captures all these moves within these 2 bands. That's it. This green band and the red band, it captures everything. Mean reversion is, the whole concept revolves around that equities, whether they are going up, down, or sideways, they don't go in a straight line. They'll go in a zigzag pattern. So if you notice that this zigzag pattern, in this case, the Bollinger Bands are capturing the top of the pattern and the bottom. And since 95% of the price movement is captured within the Bollinger Bands, the whole strategy of mean reversion is when an equity extends above the top or bottom of the Bollinger Band, it tends to revert to the mean. And the mean is the center line that you see here. So the whole strategy revolves around when a stock is at the bottom of the Bollinger Bands, you buy it or you go bullish, because your expectation is that the stock will revert to the mean. The mean is somewhere over here, this gray line. And when it's at the top, you sell it or you go bearish, because again, the expectation is that it will revert back to the mean. Another example, in this case, VRTX, you will see that you can always draw a price channel. So I drew this price channel. So this price channel is called an ascending price channel, and it's going up like this. But notice that the equity is bouncing back and forth within that channel. And again, Bollinger Bands help you spot the bottom and the top of this channel. Another example, Tesla. So Tesla is in a downtrend in this case. But again, notice that whether it's uptrend, downtrend, sideways, you can always draw a channel and you can see that whenever it hits the top of the channel or the bottom, it tends to revert back to the mean.
Nishant, just to clarify, when you say spreads, are you talking debit spreads or credit spreads?
Debit spreads. So I showed you this, right? So when the Bollinger Band, when the stock hits the top of the bands, you sell, and it hits the bottom, you buy. So it sounds like a pretty simple strategy so far. So I made a quiz for you. So in this case, this is Netflix. So it's going up and down. And at this point, it's at the top of the Bollinger Band. So would you go short?
Right. So, yeah, based on what you've shared so far, the trade here would be a mean reversion trade back to the midpoint. So it would appear that this would be a short here.
All I have told you so far is that when it's at the bottom of the band, you go bullish. At the top, you go bearish. Now let's go to the next screen. This is the spot where I was pointing to. So if you had taken that trade, if you had gone bearish, look what happened after that. So the thing is, it's not as simple as it sounds. You need to figure out at what point is the stock showing signs of changing direction. I use a total of 5 technical indicators to help me make that assumption that the stock is about to change. And I'll show you one example of the indicator that I use. Is called RSI, or Relative Strength Index. And what RSI is all it shows you is the strength of the current trend. This was the spot, if you can see my arrow on the right side, that I was asking you, should we go bearish? Now, if you look at the way RSI works is, so as long as RSI is going up, that the momentum is gaining strength. So as long as RSI keeps going up, you don't fight the trend. So in case of Netflix, you would actually ignore this top of the Bollinger Band because RSI is still strong and going up. Going back to what I was talking about, RSI. So Netflix, obviously you wouldn't have gone bearish here because the RSI was picking up strength. But at this point, you will notice that there is this faint line here. That's the level in the RSI called 70 level. Any reading above 70 means the stock is overbought. And you see at the bottom, there's another faint line. That's the 30 level. And any reading below that is oversold. So what RSI tells you, the moment a stock goes into overbought, that's when you should start looking for opportunities to go against the trend. Because once a thing goes into overbought, the chances of it reverting back to the mean is very high. So that is the time when I'm looking for trades, I look at overbought stocks, oversold stocks, and I'll keep waiting until the RSI drops below that line. So this is CrowdStrike, CRWD. So CrowdStrike is in a downward trend. You can clearly see that. And I've drawn this price channel where it's bouncing back and forth. And at this point, I haven't shown you RSI or any other indicator that I use here, but if you use the indicators I mentioned, RSI was showing at this point that the stock was oversold and it was bouncing back up above that 30 line that I was pointing out. So this would be a place where you would want to go bullish. Now, the thing is, how do you make money? So CrowdStrike, in this example, is trading at 115. You can see it here. Yeah, you see 115. So what you would do is, with CrowdStrike trading at 115, you would buy a 115 call option and sell a 120 call option. So the width of this spread, this is your spread. So you buy the 115 and you sell the 120 call at the same time. And if you look at any broker platform, all of the broker platforms will let you buy this spread as a single trade. You don't have to buy the call first and then later on sell another call to construct your vertical spread. So this whole trade can be done as one trade. So you would buy 115 call somewhere over here and sell 120 call. So imagine this is 115 call option that you bought, and this is the 120 call option that you sold. Now, how will you make money with this? So this trade costs you $250. And if CrowdStrike expires above 120, you will double your money. So you spend $250 to buy it, you can sell it for 500 and you double your money. So all my trades double their money in 30 days or less if it goes in my direction.
Now, if it doesn't go in your direction, do you wait until expiration, or do you what triggers you to exit before expiration if you do?
If a trade starts going against me, once the spread loses half of its value, so I have 50% loss. So I bought the spread for $250. If it's showing a value of 125, that means it has lost half its value. At that point, I'll close it. So the nice thing about managing a business like this is that since every winner is doubling your money and every loser is only, you lose half of your money. So one winner will cancel out two losers. So even if you had a 50% win rate, let's say you are coin flipping, every trade you flip the coin and say buy or sell. And even then, if you close your losers at 50% loss and a winner doubles your money, you will still make money. But with my system, the win rate is 70. So my wins add up way more than the losers. Does that answer your question?
Yes. Yeah. Positive expectancy.
How does high and low implied volatility affect the price of the spread that you pay?
So a high IV environment is great for selling puts or calls because you get more premium. Let's say we have a 115, 120 call option, call spread that I was buying in this case. The IV of the 120 call will be canceled by the 115 call. So I completely disregard IV. It doesn't affect my trades. The only thing that affects is the price.
Got it.
So this is the option chain. And you have your calls here and your puts here, standard option chain. Expiration, all my trades last 30 days.
So you said 30 days, but do you do weeklies at all? Do you roll out your positions at all? And
yeah, so I do weekly trades. So what I'll do is, in this example, 6th January, let's pretend that's 30 days away. I'll put on, let's say, 10 trades for that week, that expiration. Then next week, I'll add another week to my expiry. So that what will happen is every week you have 5 to 10 trades expiring. So I do weeklies, monthlies, I don't care what it is. So going back to this example of CrowdStrike, I was telling you that let's focus on the call side of we're not buying a put, we are bullish on this trade. So let's stay on the call side. These are your strikes. So that's a 115 strike and that's a 120 strike. So to construct a spread, what you would do is you would buy this 115 call and sell 120 call at the same time. And if you look at the bottom of the screen, this part where it's an order entry, that is the trade I'm about to place. So let's walk through it. So what it says is, this is the symbol CRWD, expiration 6th January. And notice that I'm buying 115 call and selling 120 call at the same time. Here it shows you what is the type of the option, call or put. That's the price. You're paying $220. So the spread cost, the nice thing about spreads is that you can decide how much you want to pay. So for a $5 wide spread, typically it will cost you $250. You can also trade a $1 wide spread sometimes by doing that. By constructing a spread, you can trade risk as little as $50 per trade, and you can double your money when the trade goes in your favor. That's how you can use even a $1,000 portfolio to trade options by using spreads. So again, in this case, this spread was $5 wide spread, cost me 220. So if you look at the math here, the spread cost me $220 to buy. The maximum you can make on this trade is $500. You paid $220, you sold it for $500, so you made $280. I mean, that is insane amount of returns in 30 days. Like, if you invest your money in any kind of hedge fund, they'll not promise you more than 40% in a year. This is 127% in 30 days. So that's the beauty of trading like this with vertical spreads. And like I was pointing out to you that, I do these challenges in my own account called the 25K challenge, where I attempt to grow $2,500 to $25,000 in approximately a year. And I've done around 10 of these challenges in my account. And that is a 1,000% return. So, obviously with trading, there's no guarantee. There can always be a 2022 year that shows up and then you don't achieve your target. But when things go in your favor, that's how fast you can grow your money. If you can double your money with every trade in 30 days, if you have positive expectancy in your portfolio, if you use technical analysis to spot trading opportunities, and if you can manage your losers by cutting them at 50% loss, that's how, if you have a trading system like that, that's how fast it can grow your money.
Great, Nishant. Thank you very much for your presentation. Do we have any final questions?
I have a lot
Do
of
I have any
questions because
final
this is so great. I have a lot, but I know we're running out of time. Perhaps, is there a way that we can reach you if we have final questions, possibly in the community?
I'm on Twitter, Instagram, YouTube. I go by the name The Mean Trader because I do mean reversion trading. I'm not mean, but yeah. The Mean Trader, you can look me up. I have a website called tradingextremes.com. Tradingextremes.com, you can contact me that way. So many ways of getting in touch with me.
Fantastic, Nishant. Great. Thank you very much for sharing your wisdom today.